Welcome. In this video, I am analyzing Sun Pharmaceutical Industries profit and loss account. I have divided this analysis into three parts. The first part, I'll analyze the profit and loss account. The second part, I'll analyze the balance sheet. And in the third part, I'll analyze cash flow statement as well as quarterly profit and loss account. Now, it is very important to understand all these three statements in detail. So let's begin the profit and loss account analysis of Sun Pharma. We'll begin with the sales and we'll look at the trend. The trend should be increasing every year. Here we see from 15 till 17 it was increasing, but in 18 there was a major dip in sales to 26,000 crores. From there on again till the recent 12 months it has picked up till 31,000 crores. So it has come back to the March 17 level. There are certain red flags that we should be concerned about. Red flags are basically problems or maybe potential problems. So one of the red flags in sales is to check for declining sales for multiple years, which we don't see here except for 1 year. Also, we should look for growth in sales, but if there is no cash being received for that sales, then that is another red flag, and that can be seen in terms of mismatch with the cash flow statement, which we can analyze later. So basically, if we are receiving, if the company has received 31,000 crores in revenue, how much of that revenue has been actually received in cash and how much is the credit sales? So that needs to be understood. As we go to balance sheet, we will look at the debtors to sales ratio, and there we will understand whether or what portion of the sales is being done on credit. Another red flag is large sales done to related parties like subsidiary or sister concern. So that also needs to be taken care of. That can be found by looking at the annual report which a company releases every year in the notes section as well as in the profit and loss account. Next, let us look at the sales growth. And in this, what we have to look for is that the 3 years growth rate should be more than the 5 years growth rate. In this case, we see the reverse, wherein the sales growth has declined over the last 3 years to 0.7%, whereas from 5 years back, the sales has been growing at 12.6%. So we want to see the recent 3 years growth rate to be more or at least in line with what it was over the period of 5 years. It will be a red flag if there is inconsistent growth or variations in sales figure. There is no inconsistent growth here as such, although the trend of the sales growth has been declining, and in the recent 3 years it is very low, but it has picked up as we saw earlier in the total sales done by the company, and there was a fall in March 18. Next, let us look at the expenses or the operating expenses and compare it with the sales done by the company. Here, there would be a red flag if there is a large variation in expenses year on year. We can see that expenses indicated in green has a growing trend, but it's not a very large variation. So this is okay because every year the expenses will grow as the sales grows. It would also be a red flag if there is increase in the purchase expenses, but cash is not being paid out to the creditors here or the suppliers. So there would again be a mismatch with the cash flow statement, which can be easily compared by looking at how much cash was paid for the purchases done by the company in the cash flow statements or in the particular section of cash flow from operations. One more red flag is large purchases which are done from related parties, and that would be considered as a red flag, because any large purchases would, maybe it would go towards manipulation of accounts. So that needs to be considered. Next, let us look at the operating profit margin. My operating profit margin target is greater than 15% or at least 15% throughout the years. Operating profit margin should be around the industry standard if it's less than 15%, and it would be a red flag if there is large variations in the operating profit margin year on year. As we can see that throughout March 15 till March 19, we can see that it has managed about 20% of the operating profit margin. So these are all okay. Even the average OPM of the last 5 and 3 years should be greater than 15%. In this case, both 5 years trend as well as the 3 years trend is showing about 25% of operating profit margin on average. In fact, in the recent 12 months also, the OPM is about 20%. Next, let us look at the other income percentage. Here we are comparing other income and the sales, that is how much income was received through sales and how much was received through the other sources. So income through other sources should not be more than 20% of sales or the revenue. So in this chart we can see that the other income is not contributing a substantial amount to the overall net profit. So there is no chance of manipulation here as such, because many companies can show a high other income in 1 year and inflate the profit, and then in the corresponding years or the future years there would be no other income and again the profit would dip. So here we can see a very low contribution of other income to the total net profit. So as a percentage of sales, it has always been less than 3%. In fact, in March 18 and 19, the other income has dipped to negative. In fact, the company had other expenses over and above the operating expenses. It would be a red flag if there is large variations in other income year on year, as I explained earlier. And we can see that overall the trend is pretty much in triple digits or lower triple digits. So there is not much fluctuation except for 18 and 19, where the company had other expenses instead of other income. Raw material cost as a percentage of sales. This is one of the major costs for manufacturing industries, and any adverse increase in the raw material cost affects the net profit. And the raw material cost should not be greater than 80% of the sales. In this case, we can see that none of the years the raw material cost exceeded even 30% of the sales or revenue generated. So the company has been managing to keep its raw material cost at a reasonable level. We should also check the raw material cost percentage with its peer group companies, just to understand how much other companies are spending vis-a-vis this company. It would be a red flag if there is large variation in expenses on raw material year on year. But we can see that there is hardly any variations in this particular graph. And it would also be a red flag if there is a mismatch of raw material expenses from the industry standard, which I have already explained before, that we also have to compare it with the other peer group companies. Next, we'll look at the employee cost as a percentage of total sales. So here, this is one of the major costs for service industries, and again any adverse increase in the employee cost would affect the net profit. Employee cost should not be greater than 50% of the sales for service industry. So here, none of the years the employee cost exceeded around more than 21% of the total sales. So this is in a pretty reasonable range. Depreciation as a percentage of sales would measure the amount of depreciation a company is charging or reducing every year from its P&L account for the assets purchased by it. So basically it is reducing the value of assets every year, and that reduction is being shown as expenses in the profit and loss account. Depreciation should not be greater than 20% of the sales. In this case, none of the years we can see that the depreciation being charged as a percentage of sales is exceeding more than 7%. Depreciation rate should be stable over the years, which it seems it is, and it would be a red flag if there is large variations in depreciation rate year on year. We don't see a large variation in any of these 5 years that we have data or graph for. I have only kept 5 years data because 5 years is a decent time to look at. The depreciation value should be stable over the years, which we can see in this graph indicated in green. The depreciation is quite stable and has been below around 2000 crores every year to the P&L account. And it would be again a red flag if there is large variations in depreciation value year on year, but we don't see that in this particular case. So we are always looking for red flags or problems in the company's profit and loss account statement, the balance sheet, and the cash flow statement. So to be on a constant lookout for these kind of red flags is very important. Now let us look at the interest percentage as a percentage of total sales. That is how much interest is being paid on the company's total sales. Interest as a percentage of total sales measures the amount of interest the company is paying or the company has to pay from the revenue earned through sales and services. The interest cost should not be greater than 20% of the sales. In none of these years we can see that the company's interest cost has exceeded 3%. So the company's interest, the amount of interest the company has to pay every year is very low. In this chart we can see how much interest the company is paying, indicated in green, over the years from March 15 onwards. Now this interest expenses should be stable over the years, which it seems to be, and there would be a red flag if there is a large variation in the finance cost. That is, in one year it is paying a very high interest cost, in the other it is paying low interest cost. For whatever reason the company may show it that way. So that would be considered a red flag. So out of the total sales in the recent 12 months of 31,000 crores, the company's interest cost is 483 crores. So that's a very low percentage of interest expenses. Next, let us look at the tax structure, or what is the tax rate the company is paying as a percentage of profit before tax. The tax rate should be around industry standard, what other peer group companies are paying. And again, it would be a red flag if there is large variations in the tax rate as a percentage of the profit before tax. In this case, we can see from 15 onwards, it has been always paying at less than 20% throughout the years, except for March 18, where it paid 26.2% of tax rate. So this particular part needs to be investigated as to why the company's tax liability increased in March 18. So here in the next chart we can see that the company's profit before tax increased to 9,048 crores, and therefore its liability of the tax also increased to 1,212 crores. The tax paid should be also stable over the years. We can see here that there is a kind of stable tax payment liability on the company, and the company has been paying taxes regularly over the years. Next, let us look at the interest coverage ratio. It measures the company's ability to pay interest on its borrowings from the total revenue earned. Interest coverage should be greater than 4 times of EBIT. In this case, we can see for every year it had always had above 4 times of interest coverage, which means that the company can easily pay its interest cost or finance cost on its borrowings. It would be a red flag if there is low coverage consistently over the years. The EBIT trend should be increasing consistently. EBIT stands for earnings before interest and tax, that is the top line operating profit or the total profit that the company has earned through the business operations, and before that is before deducting the interest and tax component. So we can see that EBIT had been increasing in the first 3 years as we saw the sales increasing, and then there was in March 18 a abrupt drop in its EBIT, and now in the recent 12 months the EBIT is at around 5,988, which is even less than what it was in March 15. So EBIT trend has decreased, or the amount of profit the company has managed to generate over the years has in fact decreased. Interest expense should also be stable or growing gradually. Interest expense, as we saw earlier also, was quite stable at less than 600 crores. Interest expenses reducing would be a positive. We see that in at least in the recent 12 months the amount of interest it has paid has reduced to 483 crores, but it is not very substantial. And it would be a red flag if there is abrupt increase in the interest cost. We don't see that here. There's no large variations in the interest payout, and it would be a red flag if the EBIT is decreasing consistently over the years, which we see here that the EBIT, although it was increasing till March 17, now till the recent 12 months also it has not managed to exceed the March 15 figure. Next, let us look at the net profit margin. It measures the company's ability to remove profit from the business activity after accounting for all the cash and the non-cash expenses. The net profit margin should be greater than 10%, and we see here that consistently from March 15 onwards till March 17 it had an above 10% of NPM. In March 18 and 19 it fell below 10%, and in the recent 12 months it has managed to exceed the 10% criteria that we have set. The net profit margin should be either stable, which it seems like there is quite a large variations in the net profit margin the company has earned, at least from 18 onwards, in 18-19 and in the recent 12 months. And we can also compare the NPM earned by this company, if it's below 10%, with the industry standard as to what other peer group companies are earning in terms of net profit, so that we can have a idea as to whether the company which we are looking at is that in a sector where all companies are earning below 10%. It would be a red flag if the net profit margin is consistently low over the years. Here we can see that the company's net profit margin fell below 10% for the 2 years of 18 and 19, and in the recent 2 quarters or 3 quarters the company has managed to bring it back up to 13.7%. The net profit should be increasing gradually over the years, which would suggest that the company's earning capacity is increasing every year. Here we see quite a fluctuation, as we saw earlier in the profit before tax also, as in sales also. So there is a same kind of trend here as well, where the net profit indicated in green was increasing till March 17 and then dropped quite substantially to 2000 crores, way below where it was in March 15, almost 50% drop in March 18, and in the recent 12 months it has managed to come back to 4,329 crores of net profit, which is a good sign, but it has still not managed to exceed the March 15 value. Again, it would be a red flag if there is inconsistency in the net profit figure over the years. We see a kind of inconsistency, so we are not able to basically make an informed decision if there is no trend or no specific visibility of the net profit. It's a red flag if there is a substantial mismatch between the net profit the company has shown and the amount of cash the company has earned through operations. This part we can see when we look at the cash flow statement in the third part, there we will compare the net profit and the amount of cash the company has actually received through operating activity in those particular years. The average NPM of the last 5 and 3 years should be greater than 10%. That is our benchmark where we expect the net profit margin to be at least 10%. And again, it would be a red flag if the average NPM over the long duration of 5 and 3 years is below 10% or below the industry standard. So in this case, the average NPMs have been above 10%. So this is quite good. Let's look at the net profit growth rate, and this particular value measures the speed or the rate at which the profits of the company is growing over the years. The red flag in this case would be inconsistency in the net profit growth rate. We see kind of an inconsistency. In fact, in the recent 5 years, as we saw earlier charts, there has been a fall in the net profit by 3.23%. Whereas in the recent 3 years, the fall is much higher at 16.3%. We want to see a positive growth rate as we saw earlier in the sales. It's a big red flag if there is a degrowth in the net profit rate, which we see over the last 5 years, it has gone into negative. In fact, in the recent 3 years, the growth rate in the net profit has fallen to 16.3%. So there's a degrowth in the net profit. And it's also a red flag if the high net profit growth rate, if there is a high net profit growth rate. In this case, in the recent 12 months, the growth rate has climbed to 62.42% from where it was in the previous year, that is March 18 or 19. From there, the profit has increased by 62%. So all these are kind of a red flags, because for both 5 and 3 years, we see a substantial fall in the net profit growth rate. This only means that the profits has fallen from where it was 3 years back as well as from where it was 5 years back. Next, let us look at the market caps to the sales ratio. This is a valuation ratio, and it compares the total sales done in a particular year with its market capitalization. And therefore, it allows us to measure what multiple we are paying against the sales done by the company. The market caps to sales ratio should be less than 2.5 times or whatever is the industry standard. In this case, we can see that the market caps to sales ratio has been declining from March 15 onwards. In March 15, the price of each share was 7 times higher than what the company did sales per share. So it was very expensive in March 15, and now in March 19 it had fallen to 3.95 times, whereas in fact in the recent 12 months it has become even cheaper at 3.47 times. So we can either select 2.5 times as our standard, or we can also use whatever the peer group companies are trading at. Market capitalization should be increasing over the years, which therefore indicates that the company's value in the market is increasing. But here we see that the market capitalization indicated in blue has been declining. In March 15, the total company's value was around 2,12,000 crores in the market, which has now fallen to 1,14,000 crores in the market. So the people are discounting, or the investors in the market have discounted this company by almost 50% since March 15 onwards. And it's a red flag if there is large variation in market capitalization over a few years. Although there is a drop, but there is no large variations. When there is large variation, it generally means that there is a large fluctuation in the share price of the stock, and therefore higher chances of manipulation as well as problems in the company. Next, let us look at the dividend payout. It measures what portion of the profit was distributed to the shareholders as dividend. Dividend payout should be consistent over the years, which shows the stable dividend policy of the company. In this case, we can see that the payout or the amount of dividend paid from the profit the company has earned has been increasing. In March 19, 24% of the profit was given out as dividend to the shareholders. Here we can see in this chart, indicated in green, the dividend amount being paid every year to the shareholders. In March 19, the company paid 660 crores as dividend against 2,665 crores of net profit. The price to earnings ratio or PE ratio is a valuation ratio. It measures how many times more we are paying for the profit earned by the company for each share. Share price would be expensive whenever the price to earning is about 25 times the earnings. So here in this case, it has always been very expensive. As can be seen from the graph, the company's price to earnings ratio since March 15 onwards had been always trading above 40 times, except in March 17 where it dropped to 23 times its earnings, meaning it was very reasonable at this particular price point. And in the recent 12 months it is available at around 25.1 times. So although this is also expensive, my criteria is that I should buy only when the price to earnings ratio is below 25 times. But we can also look at the industry standard where the other peer group companies are trading, or the average price to earnings of the last 5 years, and compare that with the current price earning. A low price earning only means that the share price is relatively low compared to the earnings of the company, whereas a low or high price earning has nothing to do with the quality of the company. So that needs to be taken note of. In this chart we can see that the company's price has been falling steadily from March 15 onwards until the recent 12 months, and the recent price is 454 rupees, which is almost a 60% drop from where it was in March 15. And even the earnings per share, we can see where it was 21 rupees in March 15 and increased to 29 rupees in March 17. The price even then was dropping till 688 rupees. So whenever there is an increase in the EPS, generally we should see the increase in price per share also. But in this case the trend was downwards. Whereas in March 18 we saw a abrupt drop in the EPS. So from here itself we can understand that whenever the EPS is increasing and the price is dropping, there is some kind of issue in the company, and that got reflected in March 18 after 1 year, where the profit all of a sudden plunged to 8 rupee 70 paise per share. In March 19 it recovered to 11 rupees, and in the recent 12 months the earnings per share is at around 18 rupees, which is in value around March 16. So the company has still not managed to get its earnings per share at the March 15 level. And we can see if from March 18 onwards till date the price has been at a very narrow range of less than 500 rupees. So the price has suffered here because of low EPS. Now when we compare the current price earning, if the current price earning is very expensive, then we need to compare it with its average price earning of the last 3 years and 5 years. So in the latest price earning is at around 25 times, which means that we are paying 25 times more than what the company has earned as profit per share. This we can compare with its last 3 years average price earning and 5 years average price earning, which was at around 42 and 41 times, which is anyways very expensive. And as of date we are getting it at around 25 times, which is almost around 40% of its average of 3 years and 5 years. So which is quite a substantial drop in terms of price to earnings. Next, we'll look at the balance sheet analysis in the next video. Thank you for watching this video.